Hi, welcome to the Market Alert for Wednesday the 2nd of March 2016. And yesterday we saw the market moving higher initially. According to the Forex Factory yesterday morning, they'd flown Dudley out to China for some unknown reason, but he was speaking there, and this is what sent the market higher in the pre-market session. He spoke at 4:30 New York time, which obviously was after the market had closed in China, and this is where you see the market take its initial leap to the upside there. Then the market went quiet, and then come 2:30 the market trading down to 16,600 before moving higher, and then we get a signal at 10 minutes past 4. We see the market moving to the upside, and I sent a note out about this one yesterday afternoon. You see how the market was just making these rising lows all the way up until we got to the 16,800 level, which gives 100 points profit at that point. And as I said in the note, I had to leave ballroom dancing on a Tuesday evening, and then the market continuing on through the session, quiet part of the session again, and up to the next target. We'll just have a look from here to the psychological level. If you were to take profits there, another 46 points, otherwise trailing the stop underneath the rising lows, which we've seen in many other videos, and there's plenty in the training section there as well. So the market moving up very strongly. The whole thing's manipulated, because if we have a look at the daily chart, and I'm going to do something different today, just going to put the volume on there. I'm just going to change the color so you can see it, and you'll see why I'm doing this in just a moment, because it's important to see the lack of energy of Newton theory, how this market's actually going up. The energy that is behind the move is absolutely nothing. You can see there, no volume at all. The last time we had anything above the average line was back in December and January. We've had nothing since. This is a market that is manipulated and is just being marked higher. And the reason they're doing that is because, as I say, there's going to be a major fall this month. I don't know why, but I just sense there's something not right. And it's a bit like 2008, very reminiscent indeed, where everything appeared to be right. We were told everything was fine, and then the whole house of cards came tumbling down, and that's what we're starting to see, and I'll show you that in just a moment, give you a bit more to back that up. But certainly it has the hallmarks and characteristics of falling apart very shortly. And yesterday I sent a note out. We marked up the 62.76 yesterday. The market drove through this, and then I said watch it go through the 16.841, which it did. And let me show you how to work out where the market's going to now, and to use the zero extension. And all you need to do is just to draw across on these highs initially, and these will show you exactly where the market's likely to find some sort of resistance before moving higher. So we can do that to begin with. All of these areas will show resistance, and I'm just going to remove all of these for a moment because I want to do something else as well, just to give you an idea of where the market could go to as well. Just remove everything, clear the chart up a bit. I'm just going to use the fib retracement tool, and I'm going to go from this high down to this low, and we're at the 62%, but watch the 17,199 as well. Let me just do something else here. I know I'm racing through this a bit, but what's important at the moment is you just get the figures of where the market is likely to go. So this is basically a 3/4 of a retracement from the high down to this low, and that's a very good area of where the market is likely to struggle. Again, use the highs of all of these drops here that we saw in December. Make sure that you have those marked up, and also keep an eye on those. But these other two areas are very important as well. You can see the market through the 62, so we can delete that. I'll just pop it back on, because obviously competence there of being able to just remove one line. Delete that one, that's it, and then we're through this one as well, which we've seen. So again, what I would do is this for today. I've got that one marked up now, and this one, which if I was to mark up, is exactly the same as the 76. So this one is a very, very important level, even if the market takes out the 16,000 969, which obviously will take us to 17,000. We're going back to the December highs. So now all of the news is very positive. Oh yes, the market's going back up and all the rest of it. It's all typical of a market that's about to collapse. It's again, it's just the same template that's overlaid every time, and a lot of people buy into this rubbish. People will be throwing their money into the markets and they'll be wishing they hadn't done so. News-wise, we've got a couple of minor central bankers out today in the UK. We've got Broadbent speaking at 10 AM, and then we've got Cunliffe speaking at 2 PM out in the US. But the biggie of the day is going to be the crude oil figures, and I think this is where the problem is going to come. Last time it was the banking crisis, this time it's going to be the fracking loans, which runs into trillions. And I'm not going to go into too much detail about that one at the moment. It's a video all by itself, how much the banks are up to their eyeballs, having lent money out to frackers when it was over $100 a barrel, and now it's $30 a barrel. It's a bit lower than yesterday, after following yesterday as well. Here we're forecast with another surplus of 2.5 million barrels as well. Now a high impact news item, because it's what's underpinning the banking system loans at the moment as well. So news wise, let's have a quick look. Most important thing first, sticking with the market and technical stuff. Implied volatility 1572. This is dropping like a stone, and this is what breeds complacency, or this is what they throw out into the market. Say everybody say, well, there can't be any risk. This is where you get your talking heads on Bloomberg and CNBC saying, well, you know, there can't be any risk because the options aren't being marked up as and used as a hedge against the stocks at the moment, so there's no issue in the market. This is the same rhetoric every time. I can tell you now, I uncovered this 20 odd years ago and it has never ever failed. Those of you who followed the market alert for the last number of years will also see how this predicted the drop in August, and if you go back further into the market alerts, you will see this play out every single time. When we get into the lows in implied volatility, we get the blue historic line below the yellow, then we have a major problem, and that's got to sort of put itself in place first. It can come before, but the lower this 1572 goes, the better. Down to the 10% area would be perfect. The one that's quoted in the mainstream is the VIX, and this is the volatility index. This is on Bloomberg's site, and again you can see how this is dropping off as well. If you look at yesterday, you'll see it dropped off quite markedly there, and over the last few days. Very similar index to the implied volatility. I prefer the implied volatility myself because it underpins the volatility in the options, which the option sellers sell. But nonetheless, if you can't get implied volatility, then the VIX is a great chart, and it looks very similar as well. As you can see in August there, we got down to the lows of 15, and then the market took off there. So the floor in the volatility index is around the same area, around the 10 there. You can see when we got here 11.26, but you can see these spikes up. It doesn't look a lot, but there's more or less the doubling of volatility. This goes back to the 7th of the 8th. This is obviously the last crash. Again, you can see the volatility low before it, and then all of these other peaks that you have in might look minor compared to here. That's because obviously that was what they now call the Great Recession. Absolute nonsense. It was a fraudulent mortgage market that broke the banks, but they were too big to fail. But that big spike is 2008, and you can see when we get to August of last year, that's the next biggest spike compared to here. When you do the research and you have a look, you can see exactly what's going on, and you can see how the volatility was too high to move the market lower because of the would overprice the options. So what's going on here is move the market higher on no volume. It's a helium balloon market, and this allows the volatility to actually collapse, which is what we're seeing. The lower this goes, the better, but watch out, this is what's coming here over on the left. And just to add to that, we can even see the originator of printing debt, or the massive amounts of debt, Greenspan from 87 until 2000 or something. I can't remember when he actually left office. But he's still lurking around in the background, and he says we're in trouble there, and you're too right, we are, thanks to what you did. You were the originator of it, the catalyst of printing masses of money, left with Bush, and then Greenspan came in, doubled the debt, and unfortunately Yellen is there to pick up the tab. So Greenspan and Bernanke's gone a bit quiet, but then again he's too busy trousering the large salary that he's got with the hedge fund that he joined after leaving the Fed. And even old Mervyn, former bank chief, he's come out and said why throwing money at financial panic will lead us into a new crisis. This was 3 days ago. Hang on a minute, the market's going up, there's no panic, everything looks fine. You see, they can see what's going on behind the scenes. And this man here, if I remember his name, blimey, Alistair Darling, he made a unilateral decision to print 600 billion of taxpayers' money to bail the banks out in 2008, thanks to the man on the right, Brown, who was terrified when all of the CEOs from the banks popped round to 10 Downing Street and said, if we don't print and save the banks because they're too big to fail, then we're going to have anarchy and people drawing the money out of the banks. So Alistair made a unilateral decision, didn't consult even Parliament, let alone the people, on whether we should be burdened with the debt of Lloyds Bank and RBS. But again, that's another story. And talking of banks and problems, Barclays shares suspended after price plunge yesterday on their appalling figures, and that's because they're as corrupt to the core as could be, and still are. And if you haven't seen the videos that I recorded about Barclays' relationship with Deutsche Bank a few weeks ago, then have a look on the YouTube channel, you'll be able to see it there. And again, you can see here they're still paying for the PPI fraud and foreign exchange rigging manipulation, as well as the LIBOR rigging. So not all bankers are corrupt, of course. I mean, I'm not going to tar everybody with the same brush, but unfortunately they are tarred with the same brush now, because there's not enough people who are blowing the whistle on the corruption at the core of these banks at the top level. But there you go, that's another thing. So let's see how today pans out and see what happens to Barclays. In fact, they haven't actually broken the £1.50 level, which I spoke about in the video, so that will be interesting to see. They're trying to hold that above there, but this is the third time now that they've suspended share trading. I can't understand why they would do that on the basis that their earnings, their profits are dropped. That's absolute nonsense. That's never happened in the history of banking shares. There's something big behind what's going on at Barclays, which they're not talking about at the moment. And I would like to proffer an opinion on this one and a guess, and I would say, as I said in the video, that they are inextricably linked and have unfortunately going to find having the trousers pulled down if Deutsche Bank goes down because of the derivatives, and they're probably linked again to the gambling market as they were in 1998 when they were bailed out, having invested 200 million into long-term capital. So I would say that something behind the scenes is going on. It's not about closing branches, although they're doing that, and reducing the number of staff. It's not about that at all. I think there's something waiting in the wings with this one. Anyway, that's it for this morning. A bit of a bumper edition, but I thought I'd give you the background as well of what's going on. It isn't what it appears to be, but only time will tell whether I'm right or not, and it's not a case of being right, it's just a matter of being forewarned of the variables that are likely to unfold based upon 20 odd years of actually looking at this, and the blatant manipulation and rigged game that it has become. Right, that's it. I will see you in tomorrow's edition. Have a great day. Thanks for your support and also for watching. Have anything to report later in the day, I'll let you know via email. Other than that, see you tomorrow. Thanks for watching.